Yes, hi Dan, and thanks for having me. Echoing what Sam was saying, totally would believe this is right in the right step. But then right now, I think what the market is looking for is more confidence, and also, first of all, we actually acknowledge how as a coordinated effort instead of a piecemeal announcement, and which might confuse the market. So the policy communications have improved. And secondly, it shows a sense of urgency to boost the market and also boost the economy. But right now, I think what needs to be, or what market is continue to watching or monitoring is, for example, how the real estate market will develop further. I think what we are waiting for is, for example, the next few key signposts that we'll be monitoring is, first of all, whether there will be further fiscal-related measures, announcements to boost consumption and also investment. Secondly, will there also be enhancement measures for example, Social Security, healthcare, and also pro-birth measures. And these will be hopefully announced between now and also the ad hoc Politburo meeting by end October. And this will decide on whether this current market boost or improvement in market sentiment will last. Secondly, market is also closely monitoring whether the measurements on these stimulus measures will actually follow through with sustainable macro recovery, particularly in the physical property market. Because right now, the sentiment remains quite weak, like bearish income and also bearish price expectations. And so these needs to be improved before we'll see a big turnaround or sustainable turnaround in the market and also in property market sentiment.
Marcella, you really do get the sense that the 5% growth target is still a key question mark at this point in Beijing. So let's watch and wait and see what unfolds there on the stimulus front. Just on another measure, we are seeing expectations for another 50 basis point Fed cut ramp up here. What does all of that mean, plus China, for your global market strategy right now? When you look at equities and bonds, how should investors be trading the macro at the moment?
Yes, indeed. Actually, post-Fed announcement, and actually with the Fed announcement, is showing how the Fed is actually focusing a lot on growth, and its rhetoric that is actually focusing on the economic growth and labor market development, and how their next move will actually depend a lot on how the labor market evolves. That suggests that we should be quite pro-risk and also support risk assets, because they will actually do a larger than expected rate cut to actually support or maintain the current economic momentum in U.S. And so we continue to believe that U.S. should be able to achieve a soft landing. And with that, that should be pro-risk and also supportive of both equities and fixed income in the near term. And especially with the after post-Fed announcements, and actually with the China hopefully improving in the economic sentiment and also market sentiment, and with the weaker potential U.S. dollar development, this should hopefully attract more capital inflows back into Asia, boosting Asia equities. With regards to weaker U.S. dollar, this should always be more sensitive with regards to India markets and also ASEAN markets, which tend to be quite sensitive to weaker U.S. dollar. But then with regards to North Asian markets, remain quite constructive because of the North Asian sensitivity to exports and also the AI development, which continues to lead the market, and also we believe should be quite constructive in the medium term.